So I'm excited, Scott, about having Victoria back to talk about the smart money moves for year end.
Yeah, Victoria Bogner, who's our head of wealth planning here at Allworth.
Yeah, and the thing that people forget is there's two types of way to look at taxes. There's tax preparation, which is where you just say how much damage has been done to me and who do I owe money to, and there's tax planning. And unfortunately, a lot of tax planning has to take place in the calendar year in which you're paying taxes on. It can't after December 31, it's gone. I mean, that's right. The ship has sailed.
Almost everything.
There's nothing you can do about it. There's few things, but
very minor.
Most things need to be done.
And that's what Victoria's covering for us.
Yeah. Looking forward.
Welcome, welcome, Vicki.
Thank you. Great to be back. I'm going to highlight just a few, especially that are the most impactful for high net worth individuals because, thresholds change. There are different tax phases. And like you said, if you miss that December 31st cutoff, you're probably locking in some suboptimal results, especially going into 2026. And this is more than just, maxing out your IRA. It's about optimizing among multiple dimensions of your financial plan, right?
Yeah.
So the first thing I'm going to talk about is actually something that we talked about on a podcast a couple of weeks ago. And that is if you have employer compensation in the form of incentivized stock options or employee stock purchase plan or something of that nature, then it's really valuable for you to get your arms around what all of those benefits are, because if you fall into a certain bracket in a particular tax year, that can help you to decide, should I go ahead and exercise some of these stock options this year, or should I wait until next year? And those are really important decisions to make because generally when you're receiving employer compensation like that in the form of restricted stock units, RSUs, things like that, they build up over time.
Yep.
So they just become this ticking tax bomb that gets bigger and bigger and bigger if you ignore it. So
assuming the stock goes up, assuming the company that employs you does well and the stock goes up.
That's right.
If it goes the other direction, you might not have a tax problem at all.
But there's techniques you can downside to that as well.
Yeah. Fortunately, knock on wood, we've been in a rising market environment this year. But that's one of the most important things that gets missed at year end is make sure you're figuring out, should I exercise some of these stock options or not in my employer compensation plan? The other thing that's really important is to think about, should I be doing Roth conversions? And the cutoff for that is December 31st. This is a great time of year to look and see, do I have some room in my current tax bracket, especially if you're in like a 22% tax bracket? Can I go ahead and take some of my IRA money, convert that to Roth assets in a lower income tax bracket, so I'm getting to choose the tax rate I pay instead of waiting till future where I either have to take distributions for my living expenses or I have huge required minimum distributions, and then I'm in like the 32% tax bracket in the future, right? So that's extremely impactful and a huge tax planning piece can save you hundreds of thousands of dollars if you set it up right. And especially coordinating with your financial advisor and your tax professional on that. And the last thing I'll leave you with, because there are so many things I could talk about, but year end is a great time to go ahead and look at your asset allocation, especially if you have taxable assets, like a taxable brokerage account that you have a whole bunch of holdings, and figure out, okay, the stock market has done well. Am I now out of alignment with where my risk tolerance is and where my assets should be? Have my equities really outpaced my fixed income, so I need to get that back into balance? And it's not just reallocating and rebalancing, it's also thinking about, what is the tax impact of selling some of these things at a gain? Do I have some things at a loss that I could sell to offset that gain? So doing some intentional tax loss harvesting, which we do for our clients if you're a client of Allworth, but if you're doing this on your own, something good to pull up and make sure that your investments are in alignment, but also tax loss harvesting in order to make that big impact, positive impact on your tax return.
One, I like, give strategically, not just generously.
Yes.
And some things for business owners, like setting up a solo K before the end of the year.
Which, you have to.
Yes,
you don't have to fund it, but you have to set it up, which is just, every year they talk about making tax compliance easier, and it just never. It seems to go in 100% the opposite direction, and that's because people have political agendas that.
Well, that's how the tax goes by politicians.
Yes.
Yep.
Well, thank
Yes,
you. Thank
I love that you pointed out the give strategically, not just generously. There's so many clients that just write very big checks to charity while they have these low basis stocks sitting in their brokerage accounts.
Victoria, I'd say even people that write very modest amounts,
The donor advised funds are
there's still ways to.
I have never, everyone I've ever introduced to a donor advised fund has said to me, I can't believe I went through all the hassle before of how I did it. They're so easy to administer. They're so easy to administer. Even if you put cash in it, it makes sense.
I've used one for
just
decades,
because it's so easy.
You click, I want to give to these three charities, click. And if the charity's not listed, they'll find it anyway. And and then you don't have to deal with when you donate you get one thing to report on your income tax return, not several.
It's so easy. Anyway, as always, Victoria. What's that?
Yes, and you can make a ton of contributions into the donor advised fund in 1 year, but then you can string out your gifting over multiple years.
Yeah, so people with modest income, they might have even large assets with modest income that aren't able to take an itemized deduction. They could bunch their giving, give 3 years worth of giving or whatever in 1 year.
Yeah, and you can choose your own investment allocation inside the donor advised fund.
That's
it's not all just sitting in cash.
That's right.
In fact, I just reallocated my donor advised fund, much like we tell clients to do with the rest of their portfolio. I did it on my donor advised fund, reallocated it.
Oh, I've about depleted my donor advised fund.
Have you?
Yes, and I thought I had more years of
You
giving.
bunch too, like I assume I bunch my giving over multiple years. Anyway, that's our own situation. Is Victoria, as always, love talking with you.
Thanks, Victoria.
Yes, same. Thanks for having me.
Really quick on that note, Pat. I remember years ago I had contributed to a capital campaign. I'm not going to get into what it was, but it was a 5 years. Can you make this contribution over a 5 year period of time? So I said yes. I believed in the cause. And year 2, I get a call from the institution. Hey, like we're a little short on cash. Any way you can accelerate? And I had money in a donor advised fund. Any way you can accelerate those contributions to just this year? Any way you can make that happen? I said, yeah. I said, let me tell you my reluctance. My reluctance is I do this, and 18 months from now, you come back asking for more money, and there's I have a finite amount of money to give. Oh no, Scott, I won't do that. I promise.
Okay.
And 18 months later,
it wasn't.
Needless to say, I never gave a dime to that organization again, and I cut ties with that individual. Like, it just felt like,
maybe it wasn't a fundraising problem. Maybe it was an operational problem. So